Gold rallied. It wasn't a big rally, but it didn't sell off. Gold and silver traders are worried about rising yields as they think, well, that's bad for gold because higher interest rates are bad for gold. Higher bond yields are not necessarily bad for gold. If you're worried about higher inflation, that's why you buy gold. All people are looking at is, oh, gold got to 5,500 and it went down to 4,000. Who cares that it went to 5,500? It's at 4,000. The dollar index slipped back below 101, 100.84. So again, that's also a bad sign, a loss of confidence. Rising interest rates didn't help the dollar. Now again, it's long-term interest rates. We didn't get a rise in short-term interest rates because the Fed didn't have the guts to raise them. Also, oil has been on a roller coaster. The trade deficit for June, 101.5 billion. Whoa, that means we have to hike. No, because when they actually hike, it's going to even be worse for the markets than the sell-off from the non-hike. Gold rallied. It wasn't a big rally, but it didn't sell off. That's the key. In fact, gold was down maybe 20 or 30 bucks before we got the decision. Then it rallied just before the decision came, about a half hour before, got to up 15 bucks or so. And it got as high as up $80 after Warsh was talking during the presser. It got up to about 80 bucks. But when the bond market rolled over, that hit the stock market. And that, because gold traders look at the yields and they think that rising bond yields are bearish for gold. They're wrong. They're actually bullish for gold.
Gold refused to break even as bond yields climbed, exposing a market signal most investors still misread. Peter Schiff notes that rising long-term yields driven by eroding confidence are fundamentally different from yields rising on economic strength. That distinction matters because institutional capital often rotates toward hard assets. When monetary credibility weakens, investors chasing headline narratives risk missing the deeper shift already underway. Next, Peter Schiff reveals why gold's resilience contradicts Wall Street's interpretation of higher yields.
We're saying that gold, which had rallied about 80 bucks, sold off, but it never went negative. It never went below 4,000. And in fact, it closed up about $40 on the day, about 4,070. And silver, which was up about $1 and change at one point, sold off to about unch, and then ended up closing up about 50 cents at 57.50. And the reason that gold and silver traders are worried about rising yields is they think, well, that's bad for gold because higher interest rates are bad for gold. Higher bond yields are not necessarily bad for gold. It depends on why those yields are rising. And if bond yields are rising because bond investors are losing confidence in the Fed, because bond investors are worried that inflation is going to be higher because the Fed is too timid to hike rates or slow money supply growth because it's too worried about adverse effects on the economy.
Gold held above $4,000 even after surrendering half its rally, while silver still finished higher despite bond volatility. According to Peter Schiff, the crucial question isn't whether yields rise, but why they rise in the first place. When markets demand higher compensation because trust in policymakers is fading, precious metals often absorb that lost confidence. Savers ignoring that distinction may be protecting the wrong assets. Next, Peter Schiff exposes why bond investors may be sending a warning the Fed cannot dismiss.
That is also bullish for gold because the loss of confidence in the Fed is why you buy gold. If you're worried about higher inflation, that's why you buy gold. It's the same reason you wanted to sell treasuries. In fact, the smart thing to do as a result of what happened today is to sell treasuries and buy gold. And clearly, some of that happened today because treasuries went down and gold went up. Gold is the last safe haven standing. And a lot of people I know recently have been questioning whether gold has lost its luster as a safe haven, whether it's no longer a store of value or an inflation hedge. Yeah, that's all a bunch of BS. It hasn't lost anything. All people are looking at is, oh, gold got to 5,500 and it went down to 4,000. Who cares that it went to 5,500? It's at 4,000. Where was it a couple of years ago? Where was it 10 years ago, 20 years ago, 25 years ago? Gold hasn't lost anything. The problem is a lot of people never really had confidence in gold because they never really understood it. And they had a lot more confidence in the Fed because they didn't understand the Fed either. They don't understand the Fed and they don't understand gold. But I think more people are going to start to understand that as they start to perceive the dilemma that the Fed is in. They can't hike rates and they can't not hike rates because the markets are going to go down regardless of what they do. Now, the dollar was down today as well, not a lot, but the dollar index slipped back below 101.
A declining dollar alongside falling bonds is an uncomfortable combination for anyone relying on traditional safe assets. What Peter Schiff is highlighting is that gold's long-term role hasn't changed even if short-term price swings dominate headlines. Confidence, not price volatility, ultimately determines where capital seeks protection during monetary uncertainty. Investors focused only on recent pullbacks often overlook decades of purchasing power preservation. Next, Peter Schiff reveals why the Fed's policy dilemma strengthens gold's long-term case instead of weakening it.
We're at, I think I'm looking at it, 100.84. So again, that's also a bad sign, a loss of confidence. Rising interest rates didn't help the dollar. Now, again, it's long-term interest rates. We didn't get a rise in short-term interest rates because the Fed didn't have the guts to raise them. Also, oil has been on a roller coaster. You know, we got a big drop in oil prices on Monday because Trump de-escalated the rhetoric he escalated. So after talking about bombing the shit out of Iran or whatever he said, I think on Sunday he said, you know what, we're not going to bomb them after all. They're playing nice. And then, I don't know, a day later, he came out and said, that's it. I got to bomb the hell out of these guys. And so oil's been on a roller coaster. And in fact, right now, let me check where oil prices are trading because they were over $90 a barrel when I finished my podcast on Saturday. And they're lower than that now. We had Monday and Tuesday, oil went down. Today it went up. Now we're back about 84.5. But we're still trending higher on oil prices, which is also problematic and which is another reason why the Fed should have hiked rates. And once the markets figure out that the Fed can't fight inflation because the adverse consequences are too serious, they can't admit that. So all they can do is talk, but talk doesn't work anymore. These should be a huge rally in gold, huge decline in the dollar. Bonds should continue to fall, and this should spill over into an overvalued stock market that needs to come down.
The dollar weakened even as long-term yields climbed, a combination that rarely signals confidence in monetary policy. Peter Schiff's argument suggests markets are beginning to separate central bank rhetoric from economic reality as inflation pressures remain stubborn. Rising energy costs only amplify that credibility problem by making future price stability harder to achieve. Investors should watch policy reactions instead of political headlines because markets eventually expose the difference. Next, Peter Schiff unravels why inflation expectations may be driving capital far faster than official forecasts admit.
Anyway, we got some economic news that came out during the week that I want to mention. Most significant was probably consumer confidence, which unexpectedly took a drop. I think one key number in there was at a 5-year low. So, despite, the claims of how great the economy is, coming from not just Donald Trump, but coming from the Fed, right? We have this really, really strong economy. Consumers, confidence at a 5-year low in certain aspects at 90.8. Maybe the Fed realizes, and that's one of the reasons that the Fed doesn't want to hike, is because it realizes that the economy is a lot more fragile than it is publicly pretending by talking about how resilient it is. Yeah, it wouldn't be that resilient if the Fed really started to fight inflation with rate hikes. We also got the trade numbers. Again, this is the merchandise trade. The trade deficit for June, 101.5 billion, a little bit less than 105.8 billion in the prior month, but exceeding expectations. But most significantly, it's still north of $100 billion. Imports down 2.6% on the month. That's what helped. Exports, though, also down 1.8%. You know, I noticed on X, somebody pointed this out, and I reposted it. But somebody put up a chart of the last of the 18 months prior to Trump and the 18 months since Trump. And the trade deficit in goods is actually a little bit higher in the post 18 months than the pre. It was 1,738,784 before the tariffs.
Consumer confidence fell to a 5-year low, even while officials continued describing the economy as resilient. This is where Peter Schiff's thesis shifts from market prices to economic psychology, where confidence often breaks before the data catches up. Persistent trade deficits and weakening sentiment suggest structural issues that interest rate policy alone cannot easily solve. Long-term investors should pay attention when confidence diverges from official optimism. Next, Peter Schiff exposes why deteriorating consumer confidence could matter more than headline GDP growth.
And now with the tariffs, it's 1,801,377 billion. So it's bigger. We have a bigger trade deficit with the tariffs than before the tariffs. Now, it's hard to say where it would be if we had never imposed the tariffs. I mean, maybe the trade deficit would be even bigger than that. I don't know. But one thing for sure, the tariffs didn't turn anything around. They didn't improve our trade deficit. The trade deficit is not lower because we have these tariffs. It still went up. And of course, we had to pay the tariffs on top of that. So we imported a lot more stuff and we had to pay higher prices because in addition to what the stuff cost us, we had to pay the tariffs. All right, so the tariffs are a complete failure any way that you want to look at them.
Trade barriers promised relief, yet the deficit expanded instead of shrinking. Peter Schiff notes that outcomes matter more than political promises, because markets ultimately judge results, not intentions. Higher import costs without meaningful improvement in trade balances leave consumers absorbing the burden, while structural imbalances remain intact. Investors should focus on measurable economic trends rather than policy slogans. Next, Peter Schiff reveals why trade policy may be creating inflationary pressure instead of reducing economic vulnerabilities.
Well, what's happening now is the markets are reacting to this apparent disparity, the complete difference between the Fed's words and the Fed's actions. And now the Fed is losing credibility. Now, Warsh is getting a credibility problem. The markets gave him some credibility. And remember, I kept saying from the beginning, the whole idea that he's going to be an inflation hawk, that he's going to be tough on inflation, that he's going to be another Paul Volcker was all BS. That there was no chance that that was going to happen because politically it can't happen based on the economic fundamentals. The fundamentals are we have so much debt. This whole economy is such a massive bubble that if we actually tried to do what Paul Volcker did, we would create an economic condition much worse than what they perceive the threat to be from inflation. So they're not going to do anything. But at this point, I think the Fed is now damned if they do, or we're damned if they do, and we're damned if they don't, because even if the Fed doesn't hike rates, the markets are going to crash. If it does hike rates, they're going to crash even more. So it's not that the Fed can look at the market reaction to their lack of a hike and think, whoa, that means we have to hike. No, because when they actually hike, it's going to even be worse for the markets than the sell-off from the non-hike. But I think we're at a point where regardless, the markets go down because the Fed can't keep sending these missed signals and losing all of its credibility.
The biggest market risk may not be inflation itself, but collapsing confidence in the institution managing it. According to Peter Schiff, excessive debt has narrowed the Federal Reserve's policy options to the point where every choice carries significant consequences that leaves investors facing uncertainty, regardless of which direction rates move next. Your credibility, once lost, is exceptionally difficult for central banks to rebuild. Next, Peter Schiff exposes why the debt burden may be dictating policy more than inflation itself.
Because once you realize that the Fed is just BS and Warsh is just talking, that is a big loss of confidence, especially for the bond market. And if you're losing confidence in the bond market, well, the stock market is going to follow. And what happened to bonds today? Yields rose. The highest I saw, the 30-year Treasury, was 5.22% on the day. That is the highest it's been in about 20 years, before the 2008 financial crisis. So this is a new high. The yield on the 10-year didn't quite make a new high because it got to 4.69. So still didn't see it above 4.7, but we could easily be there by tomorrow. But the decline in bonds is why the stock market sold off. In fact, the market was down before the announcement. In fact, I think maybe on the lows, the Dow was down 700-800 points. And the NASDAQ was down not quite as much percentage-wise because it got killed the prior couple of days. But when we didn't get a hike, we got a rally in the market. I mean, the Dow didn't go positive. I think it may have been down 300, 400 points at its best. But the NASDAQ reversed and went positive. But when the bond market rolled over and sold off, even though the Fed didn't hike, and in fact, not hiking is bad for the bond market because it shows that the Fed doesn't really have zero tolerance for inflation.
20-year highs in long-term Treasury yields should make every conservative investor pause. What Peter Schiff is highlighting is that bonds can lose their safe haven status when inflation credibility deteriorates faster than policymakers respond. That shift has historically forced investors to reconsider where genuine capital preservation exists. Watching both bonds and stocks weaken together deserves far more attention than a single Fed announcement. Next, Peter Schiff reveals why bond market stress may be sending gold a stronger signal than equities.
In fact, I interpret what Warsh did today, leaving rates unchanged, as choosing inflation. That's what he chose. He told everybody inflation was a choice, and then that's exactly the choice that he made. Well, when the Fed chooses inflation, people who hold 30-year Treasury bonds choose to sell them. And they also choose to buy gold. Gold was down. And I'll get to gold in a minute. Let me just start with the markets. So the bond market sold off, and that's when the stock market rolled over. So the market closed on the lows of the day. The Dow was down 2.2%, which is about 1,100 and change. S&P not quite down as much, 1.5%. The NASDAQ down 1.7%. But the triple Qs, which is the NASDAQ 100, that was down over 2%. And in fact, on the week now, that index is down over 3%. As I warned on the podcast I did on Saturday, I thought we were going to see a bigger pullback in the AI-related stocks as the air came out of that bubble. And that's exactly what happened. In fact, Meta's getting beat up after hours. It missed on earnings. It's down about 10%. Microsoft beat, but it's only up maybe a couple of percent. But a lot of the chip stocks have gotten clobbered so far this week, like I warned. I mean, one example is SanDisk, which is down 30% so far in the first 3 days of this week. Monday, Tuesday, and Wednesday, 30% drop. Now, sure, the stock is still way up on the year, but, it's been cut in half and, a big move just in the last few days from that. But
markets celebrated the Fed's pause briefly, then sold off as bond investors rejected the message. Peter Schiff's argument suggests institutional money often reacts to inflation expectations, long before equity investors fully appreciate the implications. When both bond and growth stocks weaken together, portfolio diversification becomes far more challenging than conventional models assume. Ignoring those cross-market signals can prove costly over time. A